Welcome to today's webinar, sponsored by OnApproach and the CU App Store. My name is Pete Kears, and I'll be your moderator today. I'm Partner Manager for OnApproach, a QSO focused on data and analytics. Through its M360 Enterprise Data Warehouse solution, OnApproach provides credit unions with the means to transform their data into action that benefits members. We've also launched the CU App Store. The CU App Store is the global marketplace for applications that help turn OnApproach M360 data into reports and analytics that provide valuable insights for credit unions. With applications developed by both credit unions and vendors, the CU App Store provides the industry with a place to build and share analytic applications. Check out the CU App Store at www.cuappstore.com. Today, our topic is Win the War for Deposits. Economics and rising interest rates are driving competition for deposit growth to levels not seen in a decade. Soaring loan to share ratios are moving deposit growth to the top of the C-suite agenda. Yet the focus of most credit unions has largely been on credit, payments, and compliance. There's a need for innovation in deposit space to win the war for deposits. Today's webinar will explore the strategic value of deposits and look at how you can grow deposits profitably. Our presenter today is Mary Durango of FlowTracker Analytics. She is joined by subject matter experts Boris Massip and Dave McNabb. And with that, Mary, I will turn it over to you.
Thank you. Good day, everyone, and welcome. I'll be performing an interview focused on what you, the credit union, can do to win the war for deposits. And I know you're going to find this interesting because it's that time of year when many credit unions are planning for next year. I'm COO at FlowTracker with many years of management experience in strategy and analytics for the banking industry, and I'm happy to be here. Now I'm going to ask Boris and Dave to introduce themselves.
Good afternoon, Mary and everyone. My name is Boris Massip. I'm FlowTracker Chief Marketing Officer. I have a background in business transformation with multiple years of experience in that space and a deep background in customer experience, operational strategy, and change management for both banks and credit unions.
And I'm Dave McNabb. Thank you for joining us today. I'm the CEO of FlowTracker Analytics, and I have been in the industry for about 35 years in consulting, in management, largely focused on analytics and profitability, as well as understanding member behavior. We hope we bring you some very interesting and practical content that you can take back to your desk and use later on as the season progresses.
Thank you. FlowTracker Analytics, Inc. is an OnApproach partner for just over a year now. We have many synergies that make us a good match. We focus on the flow of money within accounts to uncover secrets that your data holds, data you already have, but we filter it to focus on growing deposits. We unveil member behavior to help you attain balanced growth. With this information, you can have more focused marketing, delivering better results, and will allow you to dig through your data to discover new ways to find good prospects and improve the effectiveness of selling and cross-selling. Now I'm going to turn my attention to the listeners. I have a poll questions for you. Deposits are critical to maintain lending capacity, low cost of funds, and delivery of value to current and future members. How much focus is your credit union placing on deposit growth in 2019? We'll give you a few minutes to make your selection. Thank you for your responses. That's terrific and what we expected. The content of today's webinar will be very relevant. My sense is telling me that the last 10 years have been good for credit unions. Dave, would you like to comment on that?
Sure will. Well, since the crisis that happened, the liquidity crisis back in 2008, there's been a lot happening, obviously, and everybody knows that. Interestingly, the crisis was primarily a bank crisis, and the credit union industry progressed very well through the dip and beyond. The total number of failures that occurred between 2000 and 2010 in the credit union industry was only 66. there were 290 bank failures. So as an industry, we should be very proud of the record there. There was also zero bailouts of retail credit unions. There was some wholesale, but the retail credit union space, the sound management practices that we practice have resulted in actually a tremendous uptick for the brand of credit unions in terms of being not the people who are going to go to the government for help, and stable, well-managed institutions. Throughout this period too, and this is now looking from 2008 to present, maintaining market share against the banks. All the research supports that the market share of credit unions has in fact been able to, hasn't grown much, but it at least has been keeping up. And we've had extraordinary loan growth, which is a great thing for profitability. I want to comment a little bit on regulation because that's a huge problem for the industry. So looking at some headwinds here. And the regulations that came in, of course, were applied to everybody in the financial services, and it's really an industry crisis rather than just a bank crisis, which is where they should have put the regulations. The average cost or the regulatory burden per member of a credit union today is $71. So that's the average across the entire industry. Obviously, the larger your institution, since a lot of this cost is fixed, the lower the ratio is. But when you start talking about the credit unions under $1 billion in assets, which is at least 3/4, if not 70 or more of the industry, 30% of non-interest expense is typically absorbed into regulatory compliance, which is an appalling amount of money. In fact, we don't regulate the nuclear bomb industry as tightly as we're regulating credit unions, and that's kind of madness. Good things are happening on that front, but it's been a huge problem for us. That's contributing to consolidation because having that high a fixed cost is really prohibitive to managing an institution that's smaller, and the ratio gets worse the smaller you are. So consolidation is happening and will continue to happen in a very profound way. But there's an upside to that too, because it broadens the reach and capabilities that we're able to bring to the marketplace, which has benefits for our competitive position. Other changes that we've seen that are pretty material are in the tech environment. The advent of fintech, and I guess we're a fintech, but anyway, we're not in the payments business. The ones I meant there were payments. And digital channels arising, certainly the phone channel, obviously. That's been consuming a lot of resources as well. So we're spending time on regulations. We've been trying to catch up on digital. And of course, we had loan quality issues as well, which were not as exacerbated as it was in banking, but it still absorbed a lot of our attention. Services and the cloud have come into the marketplace that offer opportunities to drive down the cost and complexity of analytics, and it's making it so that it's actually attainable. So things like modern business intelligence tools like Tableau, Power BI, and others, data warehousing on a standardized basis, is like OnApproach is bringing to market, and the kind of analytics that we do are all new and on a completely different cost-benefit analysis basis than things you would have looked at 5 or 10 years ago. The changing competitive environment is also really impacting deposits in a big way. Banks' capital requirements are increasing their appetite for deposits, and that is increasing competitive pressure. Just yesterday, I attended a webinar at the Bank Administration Institute. I know that's not the industry we're in, but it's good to know what the competitive environment's like. Interestingly, they listed a chart that showed the top 3 priorities last year and this year. Last year, deposits was not on the list. This year, 49% of the banks in their research, and BAI is a big research shop, listed deposit growth as being their #1 priority going forward. So I saw on the responses you gave us that a lot of you are recognizing the focus on this. Be prepared for a very, very competitive environment, okay? Other things that are changing, of course, are that 60% of transactions are now digital, but 80% of the sales activity still occurs in the branch. So the branch network is still key. And that information comes from Fiserv as well as bank research. Another thing that's happening, of course, is the advent of the Millennial and Generation Z people coming on board. They're really going to be demanding in terms of personalized solution. They favor institutions that have innovation as part of their brand and culture. And in the credit union industry, there's a stat that I'm going to share with you that suggests that we're not getting enough of those people in the door, because in 2009, the average member age was 45. In 2016, that's just 7 years later, the average age had gone up 3 years to 48. So it suggests to us that the acquiring new members who are younger in the millennial and Generation Z space is going to be part of the critical mission going forward.
Thank you, Dave. So with that in mind, can you inform us what is the root of the reported deposit challenge? Dave, can you talk to this too, please?
Yes, as I suggested, there's competitive pressures. Certainly the banks are crowding the space, and they're going to attack us with rates and things like that to make it difficult for us. But what's happening in the industry, this chart shows us credit unions, first of all, and it's just credit unions. All of them, by the way, 4,600 or so data points in this data set. 75.2% is the trending average for the last 5 years of loan to share ratio, and the industry broke through 80% on average in Q3 of 2017. So we're hitting a tipping point where we're starting to get very highly leveraged in terms of the loan to share ratio. To give you some concrete flavor to that, 206 credit unions are over 100% today. Okay, that data is 2018 Q2. Another 428 are over 90%. So when we look at the credit unions that are over 90% in their loan to share ratio, they're running out of room to lend. That's what, 600 and change out of 4,600 credit unions in the industry. It's over 10% of the industry. And to give you the different view of this, it does vary with size. Interestingly, 50% of credit unions over 5 billion in assets, and there's not that many of them, but nonetheless, 50% of them are over 85% in the loan to share ratio. So they have a bigger problem than average. 40% in the $1 to $5 billion range are over 85%. So they are the midpoint and above. And interestingly, as below $1 billion in assets, a lot of the credit unions are actually in pretty good shape. It does vary drastically by market. So where you are geographically located matters a lot. But nonetheless, there appears to be a size thing here that is material as well. So what's all this mean to us as management people? Well, the answer to that is that the challenge we're going to have is the regulators are going to start having an increasing problem with us relying on wholesale funding. And that's for a couple of reasons. One, of course, is the stability of core deposits is not there with wholesale funding. That talks to liquidity. That also talks to the availability of funding and our ability to expand our funding in the wholesale space. The second part is that the profitability of wholesale funds is not as good as core deposits, of course. And as interest rates rise, the cost of funds on core deposits will rise much slower than it does in the wholesale market. So this is going to have a big impact on profitability as interest rates continue to rise. And the more core deposits you have, the better off you're going to be. So that's kind of an industry as a whole level. Let's take a look at this on a per member basis. This chart shows you across the top line is actually the average share dollars per member. And the line at the bottom is the average loan dollars per member, okay? So what we see is that the loan to member ratio is rising faster than the deposits per member ratio. And that trend has been going on for a long time. This chart shows you 2012 to the present, and that's Q2 2018 data. The narrowing gap is a challenge for us. There's market forces behind this that we were kind of talking to earlier. Other things that are likely going on, and a little harder to get data points on this, is product skew. And I think this talks to the larger institutions having larger problems. A lot of indirect lending has been the fuel for a tremendous amount of the growth that people are having. And that product skew is bringing in a lot of lending without much deposits matching it up. The other question it begs is there a skew going on in terms of our member profiles? Are we in fact targeting and acquiring members who have higher lending needs than deposit needs? And are we getting ourselves into an acquisition frame that is targeting the wrong long-term structure for the business to be healthy? So just in looking at this is on a per member basis. So what this tells us in terms of action is that adding new members is not going to solve our whole deposit problem. And the reason for that is if we get members that look like the members that we are currently bringing on board, this problem is actually probably going to get worse. At best, it's going to stay the same because we're going to be adding the same appetite for loans and deposits in the same patterns that we've had before. So more of the same means no change in the ratio. And as time is going forward, that's not going to be a good thing. We need to increase the deposits per member relationship. That's vital. Okay, so what we're going to be focusing on in the rest of today's conversation is looking at how can we grow member relationships with a focus on increasing deposits. I just want to comment as an aside that this chart with the analysis, the graphs here on this page and the previous chart are available with other analyses that you can use yourself that include your credit union and your peers on a free benchmarking application that we actually publish on our website under our resources tab. I invite you to use that. We update it every quarter with the NCUA data from the call reports and provide that analysis service for free. Just something you might want to know.
Thank you, Dave. So you're forecasting that because of the looming war on deposits, credit unions will do a 360 and solely focus on deposits? First, what are your thoughts on that?
Mary, I would say that the reality is going to be a more nuanced than that. Certainly, it was not about curtailing the lending, which ultimately we all know that is the livelihood of all financial institutions. It is all about creating and maintaining a cost base that allows credit unions to continue to lend competitively. There are two sides to this equation. As Dave mentioned earlier, in particularly the larger players in the industry seem to have been funding their lending on the wholesale market. Now have loan to share ratios that are attracting the attention of regulators in some markets, and that will only intensify because of the coming focus on deposit that the industry is starting to have. That said, it should not be about fearing the regulators, but just because it is a good business practice, as it limits the credit union capacity to lend competitive today, and most important, to weather future storms. On the other side is the market. I mean, ultimately, the rising interest rates makes the model of seeking wholesale funding not quite viable going forward, as it places the credit unions on a clear disadvantage to those who are effective at capturing deposits. And we all know that being a price leader creates a brand advantage and a price advantage that many credit unions have used as the value proposition in their going to market. But once a credit union loses that brand advantage in its own market or community, it is not easy to gain it back. I would say also that lending at higher rates will also turn off members, putting on danger the entire relationship. Because once you present a loan offer that do not reflect the market, you risk the entire relationship. And it's then the statement of, I would not bank there again. Ultimately, more than anything, the numbers say that balanced growth is the way to go. A study we co-sponsored last year with the FMS clearly indicated that imbalance is a drag on performance. In other words, those who go to market a strategy focused primarily on one activity, it being lending or even growing deposits, or for that matter, reported return on equity significantly below those who follow a strategy of balanced growth with defined and focused strategy to grow both sides of the balance sheet. The case can be made that for a credit union, having lower ROE also at least eliminates the flexibility that the credit union has to deliver value to its members.
Thank you. Dave, can a credit union achieve balanced growth just by attracting new members, or will solely growing the membership accomplish balanced growth?
Well, as I commented earlier, I think more of the same will result in more of the same. So first of all, I want to back up and say acquiring new members is a good thing. lest we forget that, okay? But it's only part of the answer. Because more of the same does not change the ratio. And the other dimension of this is that member acquisition, even if you're really, really good at it and get like 10, 15% of new members in a year, which would be pretty awesome for almost anybody, it's not enough to support the growth strategy that most credit unions have. I want to introduce this, what we call the bathtub model of portfolio dynamics. If you think about a financial institution and its portfolio is like a tub full of water, it's got water flowing in through the tap, it's got water flowing out through the drain, there are ripples on the top, and there are currents flowing around inside. That's pretty much the way a deposit portfolio works, okay? But what we get into when we start taking these things apart and look at sales, attrition, variability, and product substitution, which are those different currents in their component parts, we start to see some interesting stuff. One of them is that 80% of new money growth comes from existing members, so relationships that we already have. That's a good news story because we already know who they are and we have the information base in our organization to find out more about them and to market to them more efficiently than we can by just reaching out to new members to try and acquire people off the street, so to speak. The need here, though, is to gather deposits, which means new money coming into the organization. And that's not the same as getting new accounts or getting new products. Those two metrics, which pretty much everybody in the industry has been using forever, I certainly used them when I was CFO at a trust company, $50 billion trust company back in the 80s. And they're not the right metrics because what we've learned is that a tremendous amount of the new money will go into existing products and existing, even existing account relationships. So new money is not the same thing as new products and new accounts. And the metrics we've been using historically don't tell us what we need to know. What we really need to do is grow the relationships. And that means deepening them. It does mean getting more share of wallet, as well as broadening the products and services that we have, which is tremendous for retention, as I think everybody probably already knows. And that means that going forward, cross-sell is king, but only new money counts. So when I think probably everybody on the line here has run a CD promotion campaign in the first quarter of the year, and at the end of it had a wonderful result, CD promotion, wow, we gained X millions of dollars coming in the door through that into this new product. How much of it came from money that was already inside our credit union? That's the question every CFO asks every April. And so what we have done is looked at this. And on a CD promotion, it can be as high as 80 or 90% cannibalization, which we call product substitution. And even under normal conditions, when you're not dealing with things like that, like a promo, 30% of all account level growth is actually funded by product substitution. And that includes adding new products to an existing member relationship or opening new accounts in an existing product of an existing relationship. 30% of the money was probably already inside the institution. What that means is understanding the difference between new money and product substitution is absolutely essential if you want to be able to target new money. The mirror image of this is on the attrition side. Only 20% of the attrition that you'll see in the deposit space will come from lost relationships. So if you're thinking you're closing the back door by looking at retention of members, it's important, but it's not enough. So what we actually see is money trickles out the door rather than runs out the door in most cases, and there's a process of attrition. So looking at lost accounts is looking at the situation after the fact. Looking at lost products similarly is not looking at the right thing. What you need to be looking at is the money flows. So where is the money leaving? Because it tends to leave like 3, 6, 9 months before the relationship is lost. If the relationship is lost at all, it may just be a shift in primary financial institution where you wouldn't even show up on your lost member list. So attrition, again, much like on the acquisition side, is really about show me the money. It's about show me new money, show me lost money, and separate out the product substitution, which is interesting in its own right, but separate that out from what we're targeting.
Thank you. So what are the best in class doing to attract and retain deposits, Boris?
The same service that I refer earlier on revealed that most of the industry is already aware and even expecting that growth is going to come from cross-selling and increasing the share of wallet of the customer base. The problem is that a significant chunk of the underserved customers in many credit unions portfolio are in the indirect lending portfolio. And the average cross-sell ratio for that part of the portfolio is about 5 to 10%, while the best in class are doing 20 to 30%. Now, the best in class results may seem incredibly high, but we know that it is achievable as we are working with credit unions that is achieving those numbers through the use of analytics to focus their effort. As I said, Go is not all about working hard, but it's about working smarter and using tools to target the right customer at the right time. Now, cross-selling must be managed and monitored correctly, as otherwise you risk things like what Dave mentioned earlier on, that things like the cannibalizing profitable part of the portfolio, hence wasting effort that will contribute little to growth. This is an aspect in which analytics, again, can shed light on what is really happening. Or organizations can end up pushing products that members may or may not need or want, and that can lead to troubles like last year we saw highly publicized examples of that. There is one more aspect to this. It is expected that approximately 1/3 of the industry will see consolidation over the next 3 years. So even if you are planning to be acquired or to acquire, I would say that it is really important to look at ways to prove and demonstrate the stabilities and sustainability of your deposits, but also of the depth of your customer relationships to ensure that you are able to right value your organization.
Thank you. So back to the listeners and another poll question for you. The key to grow deposits is to attract new money and retain existing deposits. Which capabilities do you currently rely on to measure sales, cross-sales, and attrition? Please select all that apply. Let's share. Thank you. That is very interesting. Thank you for your votes. Okay, enough of discussing strategy. Let's get tactical. What actions can the credit unions take? Dave, let's start with you.
Sure. I'm going to, I'm just keying off the poll that was just on the screen there. And a lot of folks are expressing that our capabilities are pretty limited in this space. And I was surprised actually in a good way to see how many folks are able to actually see, okay, we kind of got a handle on new money and are looking at the money flows, because we've proven that that is an enormous advantage in terms of being able to lift. So like deposit growth is if you think of it as a game, looking at balance growth period to period is only keeping score. And looking at, in our view, looking at acquired products and acquired accounts, new products, those as metrics, they do help move us in the right direction. There's no question about that. But they are not as precise a focus as looking at getting new money. So balance growth is only how we really keep score. It doesn't tell us what's happening or what to do. What we look at is the money flows. Money flows are more like the playbook, if you think of the outcome as being the game. They reveal how we got from one period to the next. So our balances that we had at the end of last month, and the balances we got at the end of this month, what happened in between? And our general ledger and our financial reports generally give us pretty much zero insight into that. What we want to be looking at is the money flows that happen in between, because that's how we got from time 0 to time 1. And that will show us the members' behavior. It'll show us what members are actually doing with their money. So in managing in the deposit space, it's managing that playbook. The flows is how you win the game. Following the money, we want to look at inside the balance growth numbers, and we'll show you on this chart exactly what I mean by that. In the green bars and the red bars at the account level, show the uptick and downtick in a period of time by product. And this is a bunch of different classes of CDs for a given month, and showing there's a big green bar there, which is a happy news story. There a lot of account growth in that, or dollar growth in that product during that period of time. But when we peel the onion, as you see in the call out that's there in the black box, we have the total growth is explained by a lot of different factors. It can be broken down into new and lost money. We can identify instrument switches, which is money that will have matured and rolled over. Okay. We can identify product switches, which is money that's come into this product from another product in our portfolio. For example, how much do we get from money market or that kind of thing. And when we take those switches, we can even understand them at a more detailed level to fully understand the behavior underlying this and break it down to what you see in the bottom chart there, which is looking at on the rows on that chart are which product money flowed from, and in the columns that's which product money flowed to. So we called out the number there that's circled in gold, and it breaks down into the component pieces that are showing in the bottom. This means what we're able to do is we're able to see how much new money we brought in, how much money came from other products, how much money went to other products, and how much money we lost if we were to look at the red bars, for example. So this really tells us exactly what we need to know in order to understand what's happening. This is the fact base. So the question is, okay, great, we get a better view of what's going on. The question I would have is, what can I do with that information? And we have a point of view on that. What you're looking at here is some kind of cool looking charts that actually show us flows of money. There's a different kind of reporting than we're accustomed to in the industry, but it's also very powerful. If we can visualize money flowing from one product to another, we can understand changes in product preferences within your member base. So as people are moving, say, from a rising rate environment, a lot of people who had long-term money may be going short in the anticipation of rates rising, that kind of thing. Being able to observe that in your own portfolio gives you cues to how you should be marketing, which products, which term, which location, which market segment at what time. The other thing we're able to do is reveal opportunities, okay? We can start seeing patterns in these flows of money, such as when do people put money in a money market? Do they park it in money market before they put it in a CDs, which, by the way, is a real pattern, and it actually does occur in different market segments. Looking at the pattern of acquisition, what happens after a member is onboarded in the subsequent periods. Looking at the process of attrition, what events occur up to the point when a member actually leaves us. And we can also look at it from the flip side, on the lending side, to gain insight into whether or not people are paying down cards with lines of credit, or moving from secured to unsecured loans, that kind of thing that we'd want to have an awareness of. So knowing these behaviors is really important. We can start to then infer whether members are migrating in search of returns. We can start seeing seasonal patterns, such as the tax season and the tax rebate season, because they definitely show up in the numbers. And we're also able to see the patterns that people normally go through every year in their normal accumulation of savings to money market to CD. There's a pattern there that we can unveil and understand the timing of it. So knowing that helps prepare our sales staff for the interactions they'll have with members. In a rising rate environment, this is really important because these dynamics are changing, and they're changing organically over time. So you really need to have current information on it. Historical understanding of, oh, this is the way it works, simply isn't going to be good enough for the next 5 years. We need to be able to get down to a level, as is illustrated in the little hard to read part of this chart, identify by name and branch those members that are at risk of taking money out of the institution too. One of the things that we've clued in on, and this is an extremely actionable insight, is that money coming out of CDs doesn't necessarily go straight out the door. Very often it gets parked, as the charts show here, into things like money market, into savings, into checking. And when that happens, there's two possible things we can do. First thing, well, actually, there's one thing we should do with two outcomes. The first thing is we should definitely be having a conversation with these members before they take their money out of our institution. The second thing, the outcomes that we should be looking at are, can we better suit their needs with a different term product? Or are their circumstances changing, which might be better served through some kind of a lending product so that they can keep their investment portfolio whole? This kind of dialogue with the members, it's a trigger telling us we should be having a needs conversation with our member that will help us grow certainly deposits and may even help us grow loans at the same time. So it's not, changing needs is not just about deposits, it's also a lending conversation.
Thank you, Dave. Boris, earlier in the interview, you talked about the focus on cross-selling. An important aspect of that is measuring. As we saw in the responses to the poll questions, measuring is important to our listeners. How do you measure cross-selling?
Mary, I'm also delighted with the response, and in particularly not only that they are measuring, but they are really looking at ways to measure new money, because a key aspect of a successful cross-selling strategy is monitoring the effectiveness, and a key component of that effectiveness is ensuring that you understand how much new money is really coming into the organization, the impact of product substitution, and how is that new money coming in and whatnot. In the reports that we have on the screen right now, and that we're using for this presentation, the top graphic demonstrate how the product substitution is working in their portfolio. This is like almost like going into a deeper dive of what Dave showed earlier on, and just not leaving it as at the deposits and loans and whatever, but understanding in the different categories of product what is really happening, where is money coming in, where is money going out, where in the portfolio the money is migrating, and whatnot. The other aspect something that I would say before I change is that every sales leader should be incredibly aware of these dynamics, in particularly if you are compensating your salespeople for performance. Well, on the bottom chart, what we have is how to monitor at the branch level the performance. For example, we see that the branch network of this credit union have done a fantastic is doing a pretty decent job of increasing some of the liabilities and whatnot. And we also see where in the year the migration of customers, what is it that they are losing customers and whatnot. But overall, it is a pretty decent picture. But not all is right with this. For most part, the average number of deposit products per member was in decline, and the trends have been negative for a while. So with these particular credit unions, we were able to bring to their attention and create strategies to address it. This was a problem that is related to the effectiveness of the staff at satisfying the multiple customer needs in the various interactions. How do we do it? How do we move it from the strategy to the tactical term? The one thing that we all know from marketing 101 is that for organizations are 60 to 70% more effective when targeting existing members. So we took that as a principle, and we say, let's go and try to focus on marketing existing member base, even to get that better chance of being successful at doing that. In practical terms, we look for members that were underserved. So the case in the case of this organization that we are using, the data reveal that a significant number of new members acquired in the past few months were single product members. Now, there were two elements of that. On one side, there was the fact that that those who were acquired by the branch represented a prime coaching opportunity for the sales staff on how to satisfy customer needs and how to do a more effective onboarding to try to move it from a single product to more products at once. But for those who came through the other channels, this pair with the demographics and other data, it became about creating targeted value propositions and knowing what the customers that look like them but had more products with us had, and basically target them in a very concentrated effort. After all, as we discussed earlier, we knew that it was going to be 60 to 70% more effective to focus on targeting these customers to bring us new deposits and in general to deepen the relationship than just to focus on new customer acquisition.
Thank you. It seems to me that we missed a very important topic, attrition. Important because it's often overlooked. Dave and Boris, what can you tell us about this?
Well, as you're selling, which is vital and imperative, and selling is not a bad thing, by the way, because it is a process of diagnosing and meeting needs if it's done properly. Closing the back door is something that, you're right, it is often overlooked. Now, the fact of the matter is you can't eliminate attrition altogether, okay? The big things that contribute to it other than dissatisfaction or competition are divorce, death, people moving, and job changes. So, and as well as people changing major changes in their lifestyle that may also occur. But when we start looking at just how big are those uncontrollable factors, the death rate in the United States is 1%. The moves rate is 3.9%, and that's moves out of county. So when we're talking about community financial institutions, that's really the right number to be looking at. That's only 4.9%, roughly 5%. And yet most people believe that the attrition rate in their institution will run anywhere from 12 to 15%. And those numbers have been kicked around for the last 20 years without a lot of substantiation, by the way. They're not unrealistic, in fact. But that means that 2/3 of attrition is actually controllable. So when we start to talk about attrition, the thing we've got to remember again is that member attrition is important and certainly a problem, but it's not the problem. It's not the big problem. 80% of the lost money is going to leave your financial institution from members who are still doing business with you. And that I can't emphasize that enough. That's absolutely vital to understanding. So if you're just going to watch the lost members barometer, you're going to miss the boat. And the same is going to be true when you look at lost products and lost accounts. They are not good indicators of what your actual attrition is. And they also happen at the wrong time because very frequently money leaves a product or a service long before the product or service is actually closed out. You can recognize it in your data. So focusing your resources on the money will influence both the timing and the targeting of the attrition problem that you can control. And the way to get there is to understand the cyclicality of attrition, because it varies by branch, by member segment, by product over time. So all of those factors together give you the kind of patterns you're seeing on the screen here, which are illustrations. They're actual real data, but they're illustrations of just how cyclical attrition can be. And you'll see that there's a disconnect in the upper left-hand corner, or sorry, upper right-hand corner. There's a chart showing you the changes in the balances. In the upper left-hand corner is the changes in the number of products, and the lower one's the number of instruments, which means accounts in our language. So yes, they do sort of correlate to each other, but they're not one-to-one. And certainly you need to be understanding what is going on when. We're also tracking in this particular set of charts the percent of customers, members who left, because that is also very indicative of whether the relationship is tied to the balances, ... So what we get at is understanding the cyclicality, understanding these money flows, the outflows and attrition enables us to understand who is the problem, what member segments are involved, what the problem is it focused on certain kinds of products, which might suggest it's a pricing or a product design problem. We can identify where it's happening in terms of branches and channels. We can also identify when it's happening in terms of time periods. And when we know those kinds of who, what, when, where, the only piece that's missing is why. For that, we get a pretty good hypothesis set by saying, oh, it's these kinds of members in this place at this time, and these products. That gives us a pretty good idea of where we should be looking. And if we have a really big problem and it's worthy of market research, it tells us exactly where we should be looking and what kind of questions we should be asking in our research. Why is not really the answer. You're never going to get good why answers from data analytics in today's technology world. Despite AI and big data, they're not going to give you answers to why that you can actually act on. So yes, attrition's a big deal. Yes, you can do something about it. And yes, you need information in order to get there.
I like what Dave has said. The only thing that I will add to that, Dave, is the importance of measuring. I believe that all credit unions need to measure what they value. And on one side, to avoid goals that I'd say arbitrarily and do not relate to the actual record of a branch, as it will fail to motivate staff to achieve their set deposit growth targets. I also believe that probably the most advanced in the audience are probably somewhat moving in that direction. I mean, a 15% yearly growth goal does not necessarily needs to become a distributed goal among all the branches based on head office requirements. As when goals are based on true branch historical statistics, it's easier to get staff buying into those goals, and then goals becomes a very powerful tool. I mean, with this credit union that I was mentioning in Florida and that we are using as an example, we worked out the historical performance of each of the branches. And for example, a 20% deposit target, it became 11% at branches that, due to their natural markets, were more effective at generating loans, but it was 37% in other branches, just for the fact that they could be much better based on their past performance and natural market. But goals were not just about sales goals. We also measure both the historical cross-sell and also the historical attrition that those branches were reporting. And we set goals accordingly to try to either improve the cross-sell or reduce the attrition. And let's be aware that this is going to be a journey. You're not going to go from 0 to 60 in a matter of 60 seconds. This is going to be a journey, but the first step to changing anything is to create awareness, and analytics can help you understand basically not only what you are getting, but also the how you are getting. Just as Dave said, sometimes it's not only at the why, but it's at the how, and inform the what are the next steps. That's the one thing that I wanted to add.
Thank you. Thank you, gentlemen. Good insight. So to summarize, let's see if I've got it right. To win the war on deposits, credit unions should increase their effectiveness of deposit growth by monitoring the effectiveness of selling and cross-selling efforts and measure the successes, address attrition, capture money at risk of leaving the institution. Dave and Boris, any final comments before we go to questions?
From my perspective, Mary, the only thing that I would say, it is all about measure the how, not just the what you got, but the how you got it.
I'll chime in with a couple of thoughts too. In order to make any of this happen, you need a fact-based to understand what member behavior actually is, because that's essential to your strategy development. You need to know what people actually do with their money by member segment, by product, by branch and channel, by time, and turn that strategy into analytics that are actionable, the plans that are based on market realities, opportunity lists for sales, cross-sales, and attrition based on new money and lost money and incremental money being brought in the case of cross-sales, performance metrics that actually are tied to those outcomes and measure the behavior dynamics, having analytics that identify problems and wins and show you what you're doing well and what you're not doing well, and help to guide your decision making so you can course correct. And those analytics have to be accessible. They've got to use data that's readily available. They've got to be easy for people to use and understand with your existing staff instead of adding data scientists and all the rest of this stuff. You should be able to solve these kinds of problems with resources that are already inside your organization. And that's an important part of also making it affordable. The truth is, in the industry right now, tremendous changes in technology in the last 5 years have not caught up on the deposit side. But now we are having standardized data warehouse like OnApproach offers. There's new BI tools like Microsoft and Tableau offer that are like a dime on the dollar for what it used to cost to implement business intelligence. We got cloud delivery, which is allowing economies of scale and the averaging down of the cost of delivery of advanced capabilities, and pre-built solutions such as we offer in partnership with OnApproach. So using analytics and acting on them in the marketplace is how you will win the war for deposits.
Thank you. We're going to go to questions now, but if you don't get an opportunity to ask your questions, please take note of the number, email, and website. Thank you, Pete.
Okay, well, thanks, Mary and Boris and Dave. Great information. Now the floor is open for questions. If you have a question, feel free to log it in the question area or the chat area, either one. We have 2 questions to start with. Do rising deposit rates help or not help the situation?
Love the question, Pete. In our experience, the answer is yes. Deposit products will become increasingly more attractive to members just because of the rising interest rates. We also think that the stock market recent volatility and the slowing price growth creates an opportunity for effectively marketing your CD products and other deposit products. But rising interest rates are a double-edged sword for CD. On the one side, CDs are going to start to provide good returns along with their traditional safety and security features, which is great because it will attract your customers' attention. But on the other hand, the rising rates will promote early redemption. So members can get those better returns. It has been a long time since we've been in a rising rate environment. Many credit unions will need to take a hard look at the impact of early redemption options in their portfolio and what is the impact on their funding plans.
Okay, great. Now, OnApproach is in the data business, and this question is near and dear to my heart, and that is to do what you do with FlowTracker. What kind of data do you need, and to understand the member deposit behavior, and then how far back does that data need to go?
Okay, that's pretty practical stuff. I'll handle that one. The data that we actually use to support all of the analysis that you're seeing, other than the NCUA data from call reports, actually comes down to being just a snapshot of balances. It's the same thing you show to members every day on your online banking application. Account level detail, balances, period to period, snapshots. So it's actually data that every single credit union has, or else can get with a simple extract from the core system, no problem. Even better if it's coming from the OnApproach warehouse, of course, because then we can use a standard connector, and the data sourcing issue goes to 0, basically. So all of the data that we would use in this kind of information base is readily available already in the OnApproach platform. On the question of history, something else I should mention on that. In our case, we're not actually consuming transactions to do this either. We have a patented algorithm that allows us to not need transaction history in order to do it, which makes it easier to retrofit and backfill history, which we do regularly. And backfilling history is how much do you need? Well, certainly I think going into the deposit season as we are right now, people that we're implementing like right now intend to backfill at least the last year. It's obviously there's a cost benefit trade-off, but I'd say you need at least one complete annual cycle. Going back and doing 15 years of history doesn't make sense. Typically our retention period is 24 months rolling. And so just a year of information going back so you can see the entire pattern is very instructive for going forward.
Great, thanks. One thing that is noted here is the question that in the olden days, when we thought about deposits, there was competition for deposits with other institutions that were the traditional types, like other credit unions, other banks, and so forth. But now there's a lot more fintechs and other types of entities out there, non-bank types of entities. Is there something to think about in those terms these days when we're talking about winning the war for deposits?
That's a fun one. A lot of the advances in the fintech space have actually been on payments, and the interesting thing about the payments processors is that they're not in the actual financial intermediation business like we are. The same thing goes with blockchain, by the way, which is a kind of a related question. If you have your money all sitting in blockchain on your PC, it's not earning any interest. So that is a limitation that will never be overcome by that solution. Similarly, the payments platforms, whereas they're increasing the mobility of money for transactional, everyday, day-to-day expenditures, I don't see it fundamentally changing the relationships. I think you need to enable fintech to work on for your clients to access those kinds of services on your platform, but I don't see that the fintechs are going to take out the banks. In fact, I think it's going to be the other way around. And financial institutions, the fintech industry is going to consolidate and then get bought out. That's what I would predict.
The only thing that I will add to your commentary, Dave, is that traditional financial institutions, especially the large financial institutions, that now by law have to maintain certain requirements in their balance sheets, they are going to become increasingly aggressive at replacing or going to after deposits, because just that the economy is going to continue to boom for a while. The lending growth that these institutional expects will drive their need for deposits. So they're coming after your customers. So also traditional institutions are going to become very much aggressive and trying to capture that, and expect that competition from them is going to increase significantly. As you mentioned earlier, now they are reporting that 42% of banks are saying that deposits have gone to the top of their agenda.
Well, great. Well, thanks, everyone. We've come to the end of our time here. I want to thank Mary Durango, Boris Massip, and Dave McNabb. Great information. I hope all our attendees enjoyed today's information in this session. A follow-up email will be sent to field any further questions and link to pertinent information. Thank you to my colleague, Mark Ports, for doing the back end here. And this is Pete Kears saying, again, thanks for your participation in today's presentation, and look forward to other CU App Store Presents webinars and podcasts in the future.